change of pace. I don't do that much research, not as much as our previous speaker. It's a very different market because we don't invest in equities, we invest in real estate, and Custodian Property Income REIT aims to be the REIT of choice. I'm a bit croaky this evening, so forgive me, for private and institutional investors seeking high and stable dividends from well-diversified UK real estate. And I thought I'd start by looking at the investment landscape because we may as well start on a low and then we can build up from there. For real estate, it's been a pretty challenging environment since 2022. All we hear is it's about the Magnificent Seven, it's global stocks, everyone's talking macro, geopolitical risks. The November budget was challenging for us all, I think. And for real estate in particular, rising interest rates, falling valuations since 2022. But it feels like we are poised for a recovery. So we've had a difficult time. I mean, I think if we look at the slides earlier from the biotech presentation, I think we're beyond despair, which is good, and I think we are well placed. But there are some big, hairy, difficult problems to wrestle with. So, like those who are a generation or two younger than me, I turned to AI and asked ChatGPT, why are UK REITs trading at a discount? Because I can't really make it out. It doesn't make sense to me. And this is what it said. These are the 7 reasons that it gave as to why UK real estates might be trading at a discount. And I put them into 2 categories. The 4 on the right, property market challenges. The property market isn't challenged at the moment. In fact, we are seeing valuation growth, rental growth, positive engagement with occupiers. So I don't think that is a reason that we should be trading at a discount. Interest rates are coming down, so that again should be positive. Dividend cuts, I think, are unlikely. We are seeing with rental growth, it's positive for earnings, dividends certainly for us, fully covered by earnings, and we're not seeing operating cost inflation either. So to the other 3 reasons that AI think we might be trading at a discount. Economic uncertainty. Well, we've certainly got a bucket full of that at the moment. But modest growth might not be wholly unrealistic. Liquidity, I don't really know that that's a particular problem in real estate, but I think the big one is supply and demand imbalances. Institutional investors are completely switched off to real estate. I can't think of one that has real estate on the buy list. And I think we are in a market where noise is beating information. People are just so caught up in the challenges of their daily lives, the economy, whatever it might be. Institutional investors increasingly being driven by central research functions and compliance teams who simply won't put real estate on the buy list. And that, to me, feels wrong. One of the things we can't escape, and we've heard correlation earlier this evening, that real estate is very closely correlated to UK 10-year gilts. And this chart, you can see, shows the FTSE EPRA REIT index, that's basically the whole of the listed real estate market in light blue, versus the 10-year gilt. And you can see that's near perfect correlation. What does that mean for us? It means that we are trading, actually as at today, a 20% discount to net asset value. But that it means we're also delivering an 8% plus dividend yield. That sounds pretty attractive. But I think that the market's got it wrong. Because when you look across the whole of the listed real estate market at the moment and see what's going on with M&A activity and take privates, most of those transactions being driven by private equity are being done at somewhere around or less than a 10% discount to net asset value. Yet across the whole of the listed real estate market, discounts are at about 30%. So something's not right there. The people who've got the money and are investing think a 10% discount feels good value. That's why they're doing the deal. They think there's upside in that. Yet the market's trading at a 30 discount. So there needs to be a correction. Forecast of what's going to happen to 10-year gilts. Both Goldman's and Capital Economics think that 10-year gilts might be 4% by the end of the year. So even if you just take a mathematical position on this, that would suggest a 12-13% recovery in the FTSE EPRA REIT index. However, when we saw the 10-year gilt rate spike in the back end of last year, up to 4.9%, as you can see on the chart there, property overreacted to that. So it's not just maths that you need to consider that's going to drive this recovery. We're also going to have a recovery in sentiment. So falling interest rates, falling 10-year gilts, I think should be very positive for a recovery. And the 3-month SONIA curve, not my curve, you're all familiar with it. We think interest rates are going to come down. Where are they going to get to? Maybe 4% is a sensible risk. And what does that mean for real estate? Well, firstly, as interest rates fall, it's going to improve sentiment towards riskier assets. And one would have to assume that the market sees property at the moment as a risky asset. I have a different viewpoint, but that's clearly what the market thinks. But as interest rates fall, those higher yielding, riskier assets are going to look increasingly attractive. So we should see a rotation into those currently undervalued assets, and I would list property amongst them. And directly for property, of course, falling interest rates reduce costs of our variable rate debt. That enhances earnings, and that is both good for dividends, but also very positive for property valuations. If you ask the property industry what it thinks is going to happen, this is the Investment Property Forum's consensus forecast of total returns. This is recut on a fairly regular basis. It's the great and the good of the property market, both agents, advisors, and investors. And their forecast for total return for 25 and 26 is over 8.5%, driven principally by income return, but also by a recovery in capital values. And if you break this down sector by sector, where are we seeing this growth? It's coming from the industrial sector. That's going to lead on rental growth, and that has been the lead sector in real estate for a number of years now, but still leading on rental growth. Retail warehousing or retail parks is going to lead on total return, largely driven by a capital recovery and some rental growth. But we are also seeing rental growth in offices and on the high street, two sectors that have been completely out of favour for the last few years. So generally positive news coming from all sectors of the real estate market. So that's the landscape. It's been difficult, but it doesn't make sense to me. The numbers don't add up. So I resorted again to ChatGPT because I thought I got a fairly good bang for my buck on the first question. And I asked, why should I invest in Custodian Property Income REIT? Straight to the heart of the matter. And this is what it said. And broadly, it's right. Which means that it means it's clearly been listening to some of the things I've said. We've got a diversified portfolio. Diversified portfolios have been out of fashion, but I think as we come into the next cycle of investment, it is going to be higher on people's shopping lists. What we've seen a lot of is single sector funds, increasingly being referred to as pure play funds. That feels a little bit too euphemistic for me. What do we really mean by a single sector fund? What we mean is a high risk fund, and that's fine, because high risk often also means high return, and that's certainly what we've seen in the big box industrial sector. Strong focus, but clearly it's high risk, because if you've invested in shopping centres, that's also a pure play fund, but not such a happy outcome. Stable income stream, it says. And again, it's the beauty of real estate. We have forecastable contractual income from our tenants and with rental growth. And because the sector is so unloved at the moment, you're getting a very attractive dividend yield of over 8% in Custodian Property Income REIT. But even if we were trading at par, we pay 6p per share, you've still got a 6% dividend yield. And I think one of the things we've seen is that risk premium for investing in real estate, because of the collapse in sentiment, and particularly the lack of interest from institutional investors, we've seen that risk premium grow to be really very much wider than it has traditionally been. So that's the last you're going to hear from AI, but I thought an interesting look at the problem. And now into a bit more detail about Custodian. As I said, we're diversified. We've got 150 properties across the UK. Ours is a regional portfolio. We own virtually nothing inside the M25, and that's very deliberate. That's because we can get a higher dividend yield, and we know that total return is driven by income, so it makes sense for us to focus on the highest income return we can get for a given level of risk. And what we aim to do is to provide access to that diversified, smaller regional property assets, but in an institutional grade package. There is, as I said, rental growth in the market at the moment. And if we look at our portfolio, that is a reversionary potential. So the difference between the rent we're collecting today and the rent we could get if we let the properties on new leases today of 11%. And you can see that in this chart here. The light blue line shows that reversionary potential over time. And you can see that rental growth really started feeding into the portfolio in around about 2020. And we got to that peak reversionary potential in 2023. Now, the fact that that line is on a downward trend is not a bad thing, because if you look at the bars, the blue bars, that's showing how much rent we are now collecting. So as we have picked up that rental growth, so of course you would expect the blue line to fall away, but growing the rent roll, supporting dividends, it enabled us in March of last year to pay a special dividend, to take our dividend from 5.5 to 5.8p per share for the year to March 24, and to increase the dividend for the current year to 6p per share. Because of that growing income and the earnings that has supported. We've seen the occupancy of our portfolio increase from back in 23, when it was 90% occupied, to 93.5% occupied. These are positive indicators of a healthy market, and rental growth has been running at about 1.4% a quarter. And through all of this, we've also managed to bring down our LTV, our loan to value, because our variable rate debt was increasingly expensive, and as we brought that down again, that has been accretive to earnings. So these are all good news stories. And looking at some real assets, where we've seen that growth, we've seen it in the industrial sector. Now clearly I've picked out the best, haven't I? And I'm not going to show you all my dirty washing, but if I were to show you the full list of properties where we have had rent reviews and lease renewals in the industrial sector, I think the lowest increase in rent we've had is 12%, and some of the highest you can see up to 62% rental growth. But it's also in the office sector, in Oxford and in Leeds, and on the high street in Shrewsbury and in Edinburgh. And the sector that I think, as I mentioned earlier, we should be watching is retail warehousing, because I think we're going to see a real recovery in values here. It is a sector that is very short in supply. There is very difficult to get planning permission to build new out-of-town retail units, and there is strong demand from the retailers for these large format stores. It's free parking. We all like to use them. None of us can be bothered to go to the high street and park in the multi-story car park and carry shopping bags, for goodness sake. We like to drive, park for free, do the shopping we need to do. It's great for click and collect, and the retailers really like it. And we're seeing both good rental growth and capital value recovery in that sector, which is no bad thing, because it makes up 22% of our portfolio. Anyone would have thought I'd planned that. And the largest sector of our portfolio, 41% of the income comes from the industrial sector, which, as I mentioned earlier, the consensus forecast suggests that's where we will still see the greatest amount of rental growth. So our portfolio is focused on those two sectors because that's where we see the most rental growth. Now, I can't promise that we recut our portfolio every 2 weeks, but we do rake through the portfolio once a quarter when we have an independent valuation. We have what we call a buy-sell meeting. We ask ourselves the question, based on the current valuation, would we buy this property? And if we wouldn't buy it, should we sell it? And sometimes the answer is yes, we should sell it, but it's the wrong time. The lease is too short, we need to renew the lease, we've got to get the tenant to repair the building. But we are constantly combing through the portfolio to make sure that we have the right assets to pick up rental growth. And sort of by way of example, if we go back 6 or 7 years, we started selling retail properties in small market towns. We've retained cities like Chester and Shrewsbury and Edinburgh, where there's good footfall both from tourists, and we've even bought in Winchester on the high street. But we've sold out of smaller market towns. And currently we are going through a process of selling out of offices on business parks, but we're retaining offices in city centres because that is very much the mood of occupiers. That's where they want to be. They want to be in the city centres with good amenity. So we're raking through the portfolio all the time to create the portfolio you can see there. That's what it looks like geographically, so very well spread, diversified, and split across all sectors and locations, but in the principal commercial hotspots of the UK. And when we're considering diversification, this chart, I think, paints a pretty clear picture of mitigation of risk through diversification. We have no one property let to any single tenant that represents more than 1.5% of the rent roll. And amongst our largest occupiers, we have multiple properties. So 8 properties let to Menzies, we've got 3 or 4 let to Wicks, and similarly to B&M Retail. So there is further diversification within those larger slices of the pie. One of the challenges that is often leveled at us is if you buy all these smaller properties in the regions, surely you have rubbish tenants. And the answer is no, we don't. There are an awful lot of properties in regional markets, and we pick the ones that we think will attract the best tenants. And I phrase it that way very purposefully because people often ask me, aren't you worried about tenant default risk? And the answer is no, not really, because what we buy is real estate. And as everybody knows, the first rule of real estate investment is location, and the second and the third rules as well. So if you've got the right property in the right location, you will attract the best tenants. And if that tenant leaves because the property might have become too small or they might be consolidating elsewhere, you've still got the best property and you will attract better tenants. And I think the numbers here speak for themselves. 84% of our tenants are considered by Experian to be lower than average risk. All of this allows us to pay a dividend, which, as I've said, is fully covered by earnings. And in the last couple of minutes, I'm going to jump forward and talk about our strategy. And any of you who've heard me speak before, and I definitely recognize some faces, you will have heard me talk about this strategy. The good news is the strategy is holding up even in the changing environment that we're in at the moment. And what this chart is looking at is the net initial yield of properties that have traded in the market with a lot size of under 10 million, that's the dark blue line, versus the light blue line, which represents properties of over 10 million. And what it shows is that from 2000 to 2010, there was a fairly narrow and consistent margin of about 65 basis points. Let's call that the risk premium. Since then, that margin has opened up to 150 basis points. So that suggests, with the risk premium of 65 and a margin of 150, we're getting towards 100 basis points of margin for taking no additional risk. And we're not doing that by buying lower quality property, we're just buying smaller property. And that margin has remained wide, and One of the other advantages of buying these smaller properties that are higher yielding, it means that we have a much wider margin over our weighted average cost of debt than many of our peers, and that's what this chart is showing you. In the light blue, our weighted average cost of debt, which stands at about 3.9% today, versus in the dark blue, the net initial yield of the property, and in the grey, that reversionary potential on top. So we're remaining very comfortably ahead of our weighted average cost of debt. And if we had to, which happily we don't, to refinance the entire portfolio tomorrow, the strategy would still hold. We'd still have sufficient headroom to fund that. That's what our debt looks like. 4 tranches of debt. We have a £20 million facility that expires later this year, which probably we will roll into our revolving credit facility and wait for the fixed rate debt deals to improve. They're currently still a little bit expensive in our view. And but otherwise, we've got long-dated debt running all the way out till 2032. So all of this, because I think I'm now into the questions, but one of the questions I'm sure you're going to ask me, and if you don't, I'll ask it for myself, is, well, what does that mean for performance? So this looks back to IPO, looks at share price total return of Custodian Property Income REIT in dark blue versus the benchmark, which is the Natalie titled FTSE EPRA NAREIT UK index, which is basically the UK listed property sector. And in truth, they're not very edifying numbers, are they? Benchmark 6% over those 10 and a half years, and Custodian REIT 29%. But we're at the bottom of the market. So it's 29% running into the very bottom of the market. The question is, how have we managed to beat the index? And the answer is that we all operate in the same property market. We've all seen the highs and the lows, and values gone up and down together. But each and every year, we've paid more dividend. And it's that recurring income that has driven that total return. So that's me. Any questions?
Richard, thank you very much. Question here first, please, then, Steve. Yep, thank you.
Very interesting presentation, thank you. You've got about 40% in industrial. How much of that is logistics type warehousing, and what is the chances when those leases run out of getting a decent renewal?
I don't know the answer to that. I can't give you an exact number, but at a rough guess, it's probably half of it. Because just about any, even if it's a manufacturing business, they will have logistics as part of it. You make it, you've got to ship it.
Are you into the very big?
No. The largest unit we have is 100,000 square feet. Some of the really big distribution units you see are 1 million square feet. So ours are what the property market would call mid-box, not big box.
Probably other people willing to.
And it's a much more resilient market because you could let it to manufacturers, you could let it to third-party logistics operators, you could let it to businesses where it is their whole HQ, where they'll have offices, manufacturing, storage and dispatch all in one building.
Other questions for Richard? I'll come to you in a second. You mentioned you've done a special dividend, or increase the dividend. A lot of trusts have used capital for buybacks.
Yeah.
Have you looked at buybacks? Is that something that you think is appropriate for your trust, or would you rather give the money back to shareholders via dividends?
Certainly we like to pay dividends, and we think that's where rental income should end up. It should end up in the hands of shareholders by way of dividends. That's the point of a real estate investment trust. We've looked at buybacks, but actually I don't think they make good economic sense. If we're buying back a 6 pence per share dividend, and we can invest, as we are at the moment, in solar PV on our industrial and retail warehouse buildings that are delivering a 12 to 15% return, then buying shares back to cancel a 6 pence dividend doesn't make sense. So I haven't felt the need to raise the white flag yet and say I can't invest investors' money and deliver more than that 6p dividend.
Very good.
But it's something we've looked at.
Okay.
Does the trust or the trust actually have to manage the property? So does it cost a lot to actually maintain the properties, or are you just buying good quality properties that you believe will meet the renters' requirements?
All property has to be managed and maintained, and capital expenditure is required periodically. The important thing is that we must find properties that where we spend money, that we see an equal and opposite increase in the value, an increase in the rent that offsets the money we're investing. So by way of example, we have an industrial building down in Plymouth. It's been let to Ronseal for many years. They've just left. They have to pay us dilapidations at the end of the lease. That means they have to pay us an amount to put the building back into the condition it was in when they left. So we've got a small pot of money. It won't be all the money we need to spend. Let's say that runs to 300,000, and we probably need to put another £1 million into that building. But Ronseal were paying us £4.50 a square foot. The new tenant, it's been agreed, but it hasn't been signed and sealed yet, has agreed to pay us £8.50. So that £1 million that we're investing is going to see about a 12 to 15% return on that investment. But no, it's really important to maintain the buildings and keep them up to date and keep them in the condition that tenants want to find them.
And can I ask what your NAV is? You're saying 6p per share dividend.
NAV
what's your NAV?
94.6.
Thank you.
That could be wrong.
Other questions for Richard? There's been a lot of M&A activity in the UK listed real estate sector. I think there's been some offers for warehouse REIT in the last few days. Has that impacted the Custodian Property Income REIT, and do you see that continuing? Is that something you could take part in?
There has been a lot of M&A activity in the sector. I have been pleased to see recently that the warehouse REIT have said no 4 times, we've been told, to approaches that have been made. They were probably in fairly quick succession. Assura, who also real estate investment trust, have said no. And I think it's really important that boards stand up and say no to opportunistic investors who are buying the stock to agitate because they know it's cheap. I started my little bit by saying that discounts are at 30% and people are bidding for these companies at a 10% discount. They know it's cheap and they know they're getting a deal at a 10 discount. If all of these trusts roll over and get sold for cash, what are we going to invest in next year when everyone wants to invest in real estate? So I hope we see a little bit less of it, but it's just a fact of life. It's happening.
And do you benefit from improved valuations as a result? If a bidder's willing to pay a 10% discount, but does that translate through to the valuations that you can...
That would be the logical conclusion, but it hasn't happened yet.
Other questions for Richard? Anybody? No? In which case, let's go for a drink. Thank you very much, Richard. Thank you for joining us. Thank you.